Today, we're tackling the next financial crisis, but we're not going to look at it as some random event. We're asking, is it something we can actually see coming, a pattern that's unfolding right before our very eyes? So let's just ask this. What if all the economic turmoil we're seeing isn't just random chaos? What if it's actually a predictable sequence of events? A cycle that has repeated itself for hundreds of years, driven by timeless, universal forces. That's the core question we are digging into today. And to help us answer that, we're going to turn to investor Ray Dalio and his framework that he calls the Big Cycle. Now, don't think of it like a crystal ball. It's more like a historical map. It's a map that can help us understand where we are right now in 2025 by showing us where others have been before. Okay, let's dive in. To really get what's happening in the present, we first have to understand the template he lays out. Dalio's whole argument is that these huge economic shifts, they're driven by just a few key interlocking cycles. And the big one, the most important of them all, is what he calls the Big Debt Cycle. And you can see how it plays out, right? It's a pretty logical progression. It all starts out great with productive borrowing. That's when credit is used to fuel real growth. But then, human nature kicks in. We get greedy, we get complacent, and that leads to bubbles and eventually way too much debt, over-indebtedness. So what happens when debts get so big they can't be paid back? Well, central banks often step in and just print more money. That's currency debasement. And when you print a ton of money, it erodes its value, which leads to a loss of trust, not just in the money, but in the debt itself. The whole cycle only really ends when the system is forced into this really painful restructuring. Now, this is absolutely crucial. The debt cycle doesn't happen in a vacuum. It gets supercharged, you could say, amplified and accelerated when it runs into these four other massive forces. Think of them like multipliers. You've got intense political fights at home that can totally paralyze a government's ability to fix things. You've got rivalries between countries that turn economic competition into straight-up economic warfare. And of course, tech disruption, which can create these huge wealth gaps, pouring fuel on that internal conflict. So when you get all of these things combining with a mountain of debt, well, that's when you get the perfect storm. Okay, so that's the theory. Let's bring it into the now. Does Dalio's map actually line up with what we're seeing today in 2025? We're about to look at some hard, cold numbers, and this is where the theory smacks right into reality. All right, first up, the most obvious sign of all, over-indebtedness. The U.S. national debt is sitting at, well, a staggering $37 trillion. It's a number that's hard to even wrap your head around. And according to Dalio's template, this is a textbook late cycle symptom. The promises that have been made are just way, way bigger than the income available to pay for them. And the cost of carrying all that debt, it's just immense. Get this, just the interest payments on that debt are now over $1 trillion a year. Let that sink in. That is more than the entire defense budget. That's money that isn't going into roads or schools or research or innovation. It's basically the financial equivalent of running on a treadmill that's just getting faster and faster. So, okay, what happens when a country needs to keep borrowing more and more and more? Well, simple. It needs buyers for its debt. But this chart right here, it shows a really worrying trend. We're seeing weaker demand at U.S. Treasury auctions. And this is a huge red flag. It's a key indicator that global trust is eroding, a really clear sign of what you'd call monetary fragility. Let's quickly break down that term bid-to-cover ratio. Sounds complicated, but it's not. All it is, it's the total dollar amount of bids that come in for a Treasury auction divided by the amount of debt they're actually trying to sell. So a high number is good. It means lots of people want to buy the debt. It's a popular auction. A falling number, which is what we're seeing now, is a big warning sign. It means fewer and fewer buyers are showing up to lend the government money. Okay, so now let's layer on one of those other forces we talked about, geopolitical rivalry. Right now, global tariffs, especially between the U.S. and China, have shot up to levels we haven't seen since the 1930s. And let's be clear, this isn't just a simple trade dispute. It's a form of economic warfare, and it adds a ton of stress to a global system that's already drowning in debt. And you see how it connects, right? This is fueled by that other force, internal political conflict, as leaders use these external rivals to fire up their base at home. So with all this going on, how do you think investors are reacting? It's pretty simple. They're running for safety. Just look at this divergence. While the US dollar has been losing value, gold, the classic timeless store of wealth, has absolutely surged. And we're not just talking about individual investors here. Central banks are leading this charge. China, for example, has reportedly been buying up a massive amount of gold on the sly, a huge move away from dollar assets. It is a textbook flight to safety, and it shows that faith in the world's dominant currency is really starting to wobble. And this strain, it isn't just happening at the government level. Nope. It's spreading. It's hitting the private sector hard. That number you're looking at shows a sharp jump in U.S. corporate bankruptcies. We're at the highest rate we've seen in more than a decade. This is classic late cycle debt stress. All those companies that loaded up on cheap debt for years, well, now that things are tightening up, they just can't afford to pay it back. So I know what you're thinking. This data looks pretty alarming, right? But is any of this actually new? Is it unprecedented? Well, Dalio's entire framework is built on one simple idea. No, it's not. In fact, we've seen these same elements come together many times before. I mean, if we just look back through history, we can see the echoes everywhere. The 1930s, that was a toxic mix of high debt and trade wars. Sound familiar? The dot-com bubble in 2000, a total valuation mania, not unlike what we've seen recently. And of course, 2008 was a masterclass in something called stability breeds fragility. That's the idea that long periods of calm actually encourage the crazy risk-taking that leads to a total collapse. So the really crucial question this timeline raises is, what happens in 2025 when it looks like all of these forces are converging at the exact same time? And that brings us right back to Ray Dalio himself. His whole point is that, yeah, the details change. The technology's different, the politicians are different, but the fundamental mechanics of debt, of human nature, of power, those are timeless. The patterns are there for anyone who's willing to actually study them. This isn't about trying to predict the exact day a crisis will hit. It's about understanding the forces that are making one more and more likely. So what's the big takeaway from all this? Look, the goal here is definitely not to make you panic. It's to encourage preparation. Dalio's whole approach is about empowering yourself through understanding. By studying these cycles, by watching for the exact warning signs we've talked about today, you can actually shift your mindset. You can go from being a passive victim of these huge economic forces to an informed observer who really gets the historical context for what's happening all around us. Ultimately, this whole framework leaves us with a really powerful thought. You've probably heard the saying, history doesn't repeat, but it rhymes. And as we've laid out today, it seems like right now that rhyme is getting louder.